Hello, welcome again. So this is our chapter 10, problem set 1. So in this part, we will be solving 3 problems. Okay, there are total 4 problems. The problem number 3 is for your practice. Okay, so let's go. The first one, acquisition cost, equipment. Okay, so I have already created the templates for the solution. So let me see. So the Oak Tree Company purchased new equipment and made the following expenditures. So the purchase price, sales tax, freight charges for shipment of equipment, insurance on the equipment for the first year, and installation of equipment. The equipment was purchased on open account with payment due in 30 days. The other expenditures listed above were paid in cash. Okay. So now let's see which are the capital expenditures that we need to add with the cost of equipment. So purchase price, capital expenditure. So I'm just writing. So let's see. C, purchase price. Then sales tax, capital expenditure. Okay. So freight charges for shipment of equipment. Yes, this one is capital expenditure. And this one, insurance on the equipment for the first year. See, this is a recurring expenditure. So this is not a capital expenditure. This one is revenue expenditure. And installation of equipment. So this one is capital expenditure. So now let's see. So the first one we'll be doing, so equipment debit. So total it's gonna be 45,000 plus 2,200 plus 700 plus 1,000. Okay, so let's make it a little bit smaller. Okay, so equipment debit. So total it's gonna be 48,900. Okay, equipment debit. Okay. And now, so what they are doing was purchased on open account. So meaning they purchased this one on accounts payable. So the accounts payable is 47,200, because see what they have said, the equipment including sales taxes was purchased. Okay, the other expenditures listed were paid in cash. So other expenditures. So let's see what are the other expenditures. So cash, it's gonna be 1,000 plus 700. Correct. So it's total 1,700. 1,000 is the installation of equipment and freight charge. These two expenses have been paid in cash. Okay, so now what we do to record the purchase of equipment. And the other thing that you can see, that insurance on the equipment for the first year is, so what we need to do, we have purchased insurance for 1 year, so it should be prepaid insurance debit, that is 900, and we paid cash for this one 900, and this one is to record prepaid insurance. Okay. And number 2, lump sum acquisition. As we said before, that in case of lump sum acquisition, we need to allocate the total purchase price based on individual assets fair value. Okay. So now, okay, Samtech Manufacturing purchased land and building for 4 million. Okay. In addition to the purchase price, Samtech made the following expenditures in connection with the purchase of the land and building. Okay. So Tidal insurance 16,000, legal fees for drawing the contract 5,000, prorated property taxes for the period after acquisition 36,000, and state transfer fees 4,000. An independent appraisal estimated the fair value of the land and building, if purchased separately, 3.3 and 1.1 million respectively. So shortly after acquisition, Samtech spent 82,000 to construct a parking lot and 40,000 for landscaping. Okay, now let's see. Determine the initial valuation of each asset Samtech acquired in this transaction. Okay, let's see what we need to do. The first one, let's purchase price. So total purchase price is gonna be, oh no, control right. Okay, so the purchase price is 4 million. Okay, then see, this is the purchase price 4 million. Okay, and now Tidal search and insurance, that one is 16,000, and legal fees, total legal fees 5,000, and then state transfer fees, that one is 4,000. Okay, and so out of these three we have included, out of these four we have included three, but we did not include this one because let me see you in the note. So the prorated property taxes for the period after acquisition are not included in the initial valuation of the land and building. So they are recorded instead as prepaid taxes. Okay, and expensed over the related period. Okay, this is the note for the prorated property taxes. Okay, so the total is gonna be underlined. Okay, so total would be equal to 4,025,000. correct? So let's close this one. So total, so this one is total cost. Okay, let me use a different color for this solution. Okay, and the allocation of lump sum based on the fair values. Okay, let's see. So the asset is land, then we have building. Okay, the fair value of the land is 3.3 million, correct? So 3,300,000, and building is 1,100,000. Okay, so the percentage it would be equal to, so the total value of these two, is equal to 4,400,000, correct? So the 4,400,000. So now what do we need to do? It would be better if we insert an equation. So it should be equal to, so the value of land, so value of land is 3,300,000, and the total value of the land and building is 4,400,000. Okay, so what is the percentage? So its percentage is gonna be 75. Okay, and here the percentage would be equal to we can easily say it's 25%, because 75% is for land, so the 25% would be for building. So the initial valuation would be equal to, let's make this one smaller. Okay, so now it should be equal to 4 million, sorry, it should be 4,025,000, correct? And now it would be, okay, it should be 75%, so which is equal to 3,018,750. Okay, I can delete this one. Okay, that is, and for the building, so it should be 25%, and the amount is gonna be, amount would be 1,006,250. Okay, so this is how we got it. So the initial valuation. So and the total is gonna be, the total would be equal to 4,025,000. Okay, total. So I hope you got it. And do we have any other what they're saying? Determine the initial valuation of each assets Semtech acquired in this transaction. Yeah, we have done this one. Okay, and now let's see the answer of this one. So in this case, repeat the requirement 1. Okay, assuming that immediately after acquisition, Semtech demolished the building. Okay, so the demolition costs were 250,000 and the salvage materials were sold for 6,000. So in addition, Semtech spent 86,000 clearing and grading the land in preparation for the construction of new building. Okay, awesome. So now what do we need to do? So the cost of the land would be, so now let's use a new, okay, so let's use this one. Okay, so now cost of land, it's gonna be, okay, make a different color, so right alignment. Okay, so the purchase price is 4 million, correct? And the title search and insurance, it is same as it was, 16,000, and legal fees, it is 5,000. Okay, then state transfer fees, it's 4,000. Then demolition of old building, that is equal to 250,000. This is the cost, and less the salvage value. Salvage value of the building was 6,000, correct? And underline. Okay, so salvage value was 6,000. So let's insert. See, if you want to insert new rows, so what you can do, you can just have your cursor over here and then just press enter. Okay, and now so it's gonna be total 244,000. Okay, fine. Now clearing and grading costs. So the clearing and grading cost total 86,000. Okay, so clearing and grading 86, and now the sum of these costs would be total cost. Okay, so the total is gonna be 4,355,000. Okay, and now close it by double underline. Okay, so the total costs of land. Okay, and just for our note, we can write say land improvements. So land improvements we have done so far. What is that? So the parking lot. Okay, parking lot. So we have spent 82,000. That is land improvement. This is a different landscaping, and that is 40,000. Okay, so this is how we answer this question. Okay, and this one is for your practice, the lump sum acquisition. And now here you go for this is a very interesting question. So acquisition cost, non-interest bearing note. So on January 1, 2018, okay, so have this one in mind. So on January 1, 2018, okay, so let's use a timeline. So to do that, we'll be using, say, actually there should be okay, there should be 2 years, correct? So 2 years, so 2018, okay, no, 2018, 19, and 2020. No, actually it should be 3 years. Okay, now let's insert 3 column. Okay, so 2018, 2019, and 2020. Okay, so 3 years, and every year has 12 months, correct? So now, so the Biner company purchased a used tractor. Okay, Biner paid, so Biner purchased, okay? Biner purchased used tractor, and they paid 5,000 down. So how much? They paid 5,000 down and signed a non-interest bearing note requiring 25,000 to be paid on December 31st, 2020. And they signed 25,000 note. Okay. The fair value of the tractor is not determinable. An interest rate of 10% properly reflects the time value of money for this type of loan agreement. The company's fiscal year end is December 31st. Okay, now prepare journal entry to record the acquisition of the tractor round computation to the nearest value. Okay, now let's see what we need to do. So the first one is 2018. Okay, 2018, and before creating, meaning before recording the journal entries, let's calculate the fair value, meaning the present value. So the present value of the note, present value of the note. Okay, so what we have, let's see, we have interest rate equal to 10% and n equal to 3 years, correct? And let's see what we will do. we will be using a present value table, and let me show you how we will be using this one. So here is the table. So here is the AN. Okay, you can see the AN. This is the 3, and since the interest rate is 10, so what we are going to do, will be doing here. So highlight. So this one. Okay. So this is, let me highlight the entire row, so it will be interesting. So this is our 10%, and here N is 3. Okay. So the present value factor is 0.751. Okay. You can see that 0.751. Okay. So therefore the present value factor from the table is equal to 0.751, correct? And what we will do, the present value of note equal to 25,000 multiplied by 0.751, which is equal to let me see, so let's use the okay, here you go. So it is equal to 25,000 multiplied by 0.751. So that is equal to 18,775. Okay. So it is 18,775. Okay. So the total value may be different if you use some more numbers over here. Okay, you will find more numbers over here in different tables. Okay, some of the tables, meaning the present value tables, usually present 3 decimal the values until up to 3 decimal places. Okay. Okay, so now we have found these values, and now let's start to record. So the tractor value, so the tractor value would be 5,000 down payment plus the present value of the note 775. So which is equal to how much? So the total value would be equal to, so again we can use the Excel file. Okay, so it's gonna be 5,000 plus 18,750. So we're 23,775. Okay, so 23,775. Okay, and now how much cash we have paid? So we paid total cash of 5,000. Sorry, and we have signed a note payable note. Okay, so the face value. So in this case, face amount we should be recording. So be careful about this one. This we will be using the face amount. So the face amount is 25,000. Okay, so the sum of these two is 30,000. Okay, so the discount on note payable would be the difference between 30. So it will be 30,000 and 775. So that this one is discount on note payable. I'm writing it. So the difference between these two and this one. So it's gonna be 6,225. So 6,225, correct? And okay. record the purchase of tractor. Okay, and now I'm deleting this entire rows. No. Delete again entire row. Okay, now so requirement 2. So how much interest expense will the company include in its 2018 and 19 income statement? So interest and interest here. Okay, let's see. 2018 interest. So the amount of interest in 2018 would be equal to, so the present value of the note is 18,000. So it's gonna be 18,775 multiplied by 10%. Okay, so the amount should be equal to how much? So 1,775. Okay, no, it should be 1,875. Okay, 75. So we can round it to nearest dollars. Okay, nearest dollar amount. So it should be equal to this one. And then in 2019, see, in case of when we are calculating the amount of interest in 2019, so in that case we need to add the amount of interest we calculated in 2018. So that is 1,875. No, actually it should be 77. Okay, 77. Okay, so it should be this one. Okay, multiplied by 10%. Okay, so which is, let's see how much it should be. So 18,775 plus 1,877, this one, let's use the equal sign. So this one 10%. So it should be equal to how much? 2,065.2. Okay, 2,065. Okay, and requirement 3. Let's see what is the requirement 3. What is the amount of the liability of the company will report in 2018 and 19? So 18 and 19 liability. Let's see. So one thing that I want to note, please keep in mind that so the liability will be decreased by discount on note and interest. Okay, so in that case, so the liability in 2018 would be equal to, so we have the note payable, the liability, and we will be subtracting the amount of discount on note payable. So 6,225 minus interest in 2018, so that is 77. So which is equal to, let's see what is the value of this one. So 25,000 minus 6,225 minus 1,877. Okay, so it's we should use the equal sign over here. So this one is so 16,898, and in 2019 our total liability would be equal to 25,000 minus 625 minus this interest for this year, for previous year. Okay, so that is 1,877 minus interest for 2019, so 65. So that is equal to and let's see what would be, so 25,000 minus 6225 minus 1877 minus 2065. So this is, so 14, so it's gonna be 14,833. Okay, so this is how we solve these problems. Okay, so if you have any question, you can ask me anytime. Okay, so thank you so much.